Welcome
Yeah.
back, everyone, to another episode on Living Your Greatness. This is your host, Ben Mummy. And the goal of my show is really simple: to learn from those who have mastered their craft of what they do. If you are new to my show, please be sure to hit that subscribe button. Today, we have a new guest to the show, and his name is Alasdair Macleod. He is the head of research for GoldMoney. So without further ado, welcome to the show, Alasdair.
Thank you for having me, Ben.
If you could just share with my listeners, your origin story. Where did you spend your formative years growing up? And, what inspired you to become a stockbroker, banker, and economist?
Well, yeah, I was born and brought up in Kenya in East Africa. And I went to school in Scotland. My parents came back to Scotland after independence in 63, 64, I think it was. And, I became a stockbroker basically because I thought that's where I could make some money. It was as altruistic as that. I enjoyed it. Originally I wanted to move on from stockbroking to do other things, but I sort of fell in with stockbroking so much so that I didn't really move on from there. I got a bit stuck. But stockbroking, I mean, on one level, you can be just a stockbroker, ringing clients and saying, I suggest you buy this or buy that, or giving them news on stocks or giving them opinions on stocks and bonds and so on. Or you can manage other people's investments. In other words, become an investment manager. And I've been a director of an investment management business as well. Or you can get involved in other financial services. And I became a director of a bank in Guernsey, which is one of our offshore islands. So my experience, if you like, covers the whole gamut of securities and credit in the wider sense. So, and that I think has given me an excellent background to understand what is going on in the world today, which I think is increasingly concerning to people who find that they don't really understand what's going on. They know that something isn't working, but they can't quite put their finger on it. So my mission in life, if you like, having retired, I'm now in my 70s, is to educate people, pass on my experience. And it's a mixture really of understanding finance, credit, economics, and also geopolitics, because that comes into it. And particularly what is money and what is credit? What is the difference? And so that's really, become my motivation, if you like, after a long career in the finance sector.
Who have been some of your greatest mentors that, helped you along the way? Because from what I understand, you have 40 plus years.
I had an uncle, my father's elder brother, who was Chancellor of the Exchequer. So one down from Prime Minister. He unfortunately died in office in 1970. I owe quite a lot to him, as well as to my own father, of course, who also was an extremely wise individual. On top of that, when I was a young man, I developed the habit of learning from others. So I would try and find someone, or I would identify someone from whom I thought I could learn things. And I had a cousin-in-law who was a banker and an active property dealer in commercial property, who made a substantial fortune, let's put it that way. And he was an incredibly nice man, very, very wise. And I learned a lot from him. So, you pick these things up through life. And if I was going to sort of pass on anything, I would tell the young, when you stop mucking around, which we all do, we all did, then try and identify the people who from whom you're going to learn most. So these people will be successful people. These are people who are balanced in their outlook. They are people who are willing to answer your damn full questions, if you like, as well. So it's all those things. I think there is a lot of wisdom in age, and I would strongly recommend anyone who is young to tap into that. Be selective who you tap into, because not every old man or old woman is wise. Far from it. But you can easily identify it. You can easily identify the wise people, and just go for it.
You know, we really are the average of the top 5 people we spend time with, right? So it is important, obviously, to be selective. But Alistair,
Yeah.
I kind of want to shift gears here. What are lessons that history can teach investors about the real value of money? Because I know you believe that money is gold and everything else is credit.
It's not a question of belief. It's a question of fact. It's a matter of fact. That gold is money. Well, let's define money. Money basically is a medium of exchange. And in this context, I would define it in the same way that John Pierpont Morgan defined it. Money is a medium of exchange which has no counterparty risk. And in law from Roman times, that has always been metals, identifiable metals, gold, silver, and copper. Indeed, the first Roman coin was called the ice, which spelled AES. And the ice basically weighed about a pound in weight of bronze or copper. And it wasn't really all that standardized, but it was refined, and it was refined, and it was refined. Now, credit is a promise to pay. That is different. When you have a currency, a fiat currency, that is a promise from your government to pay. It's a promise to pay in gold or silver, which has been suspended. They've ratted on if you like, the ultimate value of the currency. The fact that this is a counterparty risk is reflected in the issuer's balance sheet. Just look at the balance sheet of the Fed or any other central bank, and you will find that currency in issue is a balance sheet liability. It is their liability. Bank credit, obviously, you have a deposit at a bank. That, if you like, is credit in your favor, but it has counterparty risk. And that, I would say, is really the definition between the two. Now, credit doesn't just stop there. I mean, credit, the whole economy runs on credit. It doesn't run on money. Even when you have a gold standard, money doesn't come into it. Money is always hoarded, if anything. And if there's no need to hoard it, then we don't hold it. I'll give you an example. For example, if you look at Switzerland, the currency has always been firm, strong, and all the rest of it. And if you go back in history, the Swiss central bank always maintained gold reserves. And there was enough confidence that the Swiss franc was exchangeable for gold that nobody bothered to hold gold or indeed bothered to exchange it. Such was the confidence, if you like, in the Swiss National Bank's promise that its currency was exchangeable for gold, and it was backed by gold, and therefore of stable value. But of course, that has now changed. The Swiss don't necessarily hold gold because they're not really in the habit of holding gold, but they certainly deal in gold, and they're getting back into the habit of holding gold. Why? Because the Swiss central bank has corrupted its balance sheet with investments, if you like. It's corrupted its balance sheet basically by selling down its gold holdings. And the thing that's interesting is that if you look at history, the one thing that really stands out is that all forms of credit are temporary, and they eventually get extinguished. The shortest form of credit is, for example, when you buy, let's say, stocks or something like that, and you pay the following day. Now, most brokers actually take the money up front, but the settling in the market is the following day or in the following 2 days. So when you actually buy something in the market, under the true dealing terms, rather than what your broker imposes on you, you are given credit by the market because you haven't settled the bargain. The moment you settle the bargain, of course, the debt and credit eliminate. So, and if you look at stocks as well, stocks are credit. I mean, basically what you're doing is you're buying into the promise of an income stream. That is what an investment is. An investment in equities, that's what it represents. Bonds, obviously. If you own a bond, that is a promise from the issuer of the bond to pay. Now, the thing that's interesting is that if you look at wealth and try and define wealth, all that's done in credit, really. Anyone who's got any gold, that is also part of wealth, but it's a very, very minor part of the total wealth. The paradox is that if a government issues bonds, then it is creating wealth for the buyers of those bonds. As long as the debt as long as the debt exists, the government debt exists, and as long as it is credible, then the balancing credit, which is effectively an individual's wealth, is there at the same time. So expand the amount of debt and you expand the amount of credit, and of course credit is part of everybody's wealth. But all this depends on the credit actually retaining its value. The moment you start losing faith in that credit, then that value gets corrupted. And we are, in my view, deep into the situation, if you like, of collapsing credit values. And it's coming from two ends: the financial system, one, and secondly, the system of fiat currencies is drawing to a close.
What is one common myth about gold that you would like to debunk?
The one I would really debunk is that the gold price is rising. It's not. It's the value of the credit that's falling. It's a key point. The Bank of China understands this. And if you talk to anyone, they'll say, well, the Bank of China has been buying gold. No, what they've actually been doing is selling dollars. The difference is very, very important to understand. From the Chinese government's point of view, and also the central bank's point of view, the People's Bank of China's point of view, they have got too much dollars. They need to get rid of them. They are selling dollars. It's not a question of buying gold. They are selling dollars. But what do you sell your dollars for? Do you sell it for Japanese yen? Do you sell it for euros? No, because the dollar is the king rat of fiat currencies. What I mean by that is that it's the least bad of all the currencies. If you lose faith in the dollar, the faith in all the other fiat currencies disappears at the same time. We are in a dollar faith-based credit system. Dollar goes, the rest goes. So what does the Bank of China do? It gets into real money. It gets out of credit and gets into real money. It's selling dollars. And I think that's the point that I would like everybody to understand. And the longer it takes for that message to get into anyone's brain, then the more they're going to lose, if you like, as the value of credit collapses.
How does Greshams' law states that bad money drives out good manifest when two types of money with similar face value are in circulation?
Well, that's yes, that's not named after Sir Thomas Gresham, who was Elizabeth I's money man, and he was explaining why it was that newly minted coins disappeared from circulation. In those days, people would clip the edges of coins to hoard the silver, as it were. And so if you got clipped coins in your change, if you've got coins in your change, what you do is you would sort out the good coins, put them to one side, and spend the clipped coins. That was what he was describing. The bad money, which is the clipped coins, is driving the good money, which is the unclipped coins, out of circulation. And of course, we apply that now to the difference between a fiat currency and gold. That's basically where we are today. Anyone who wants to protect themselves from a collapse in credit as a medium of exchange, basically exchanges that credit for real money, which, as I've said, since Roman times has been gold and still is.
History does tell its time. It still has been playing out. But what makes gold and silver enduring stores of value compared to fiat currencies, given their intrinsic qualities?
Well, first of all, well, intrinsic qualities, I suppose you could get away with that, but there's no such thing as an intrinsic value, because value has to be judged against something else. And so it cannot be intrinsic. A mistake a lot of people make, incidentally. I mean, the point is that gold and silver, I mean, not so much silver nowadays. Let's just stick to gold, because silver is a bit of a special case. But gold is accepted everywhere. I mean, the importance of Roman law cannot be overemphasized. Very few people actually understand this, but it was the Romans who actually described the difference between money and credit. They were the people who initially developed banking, which basically was dealing in credit. So the Roman laws, if you like, differentiated between gold and credit. Now, the Roman Empire was the foundation. I mean, we're talking about the Eastern Empire and the Western Empire. They were the foundation of, it was effectively the Christian Europe. It was the foundation of all the successor nations, which then went on to colonize the world. So written into everybody's common law is this basic concept that money is gold and the rest is credit, which is why John Pierpont Morgan made that comment before Congress in 1912. Separately, the Chinese, great civilization, which only had a very, very tangential relationship with the European empires, they also came to the same conclusion, that money is gold. And I'm told that in Chinese, the word for money is the same as the word for gold. It's synonymous. The Chinese, incidentally, invented paper money. The original paper money was called flying money, which was actually invented by merchants who didn't want to transport real money, gold, if you like, in settlement of transactions, but effectively created credit notes, which would pass for money, and that was then taken up by, I think it was one of the emperors in the Tang dynasty, who then used it as the base for what governments have done ever since. Basically debasing the medium of exchange. So this is why gold is money. It is accepted everywhere in the world as money. And if, let us say, you were going to parachute some special forces into Afghanistan or wherever, I suppose nowadays you might get away with a few dollars, but basically, historically, the special forces would take coin as a means of exchange where necessary. That would be part of their pack. So it's still the case. And I remember when I was a youngster going to the Middle East, I remember that the basic money amongst the Bedouins was the Maria Theresa dollar, the silver dollar from Austria, which was still being minted in large quantities. So gold, silver, copper, metallic, it's incorruptible. And you know what you're getting. You can weigh it. You can weigh it and you can give it a value. And that value is a purchasing power. And that's the key point.
Regarding investment opportunities, it's very clear that you are bullish on precious metals as well as commodities. But why do you see this a once in a lifetime opportunity for millennial investors such as myself?
Well, firstly, we need to differentiate between investment and hoarding gold, if you like. Let's use the brutal term. Investment is basically where you deploy credit. Gold is getting out of credit. It's not investment. It's just getting out of the system to protect yourself. So I think that's a very, very important point to understand. Now, having said that, we have a world which works on the basis of investment. And so as a stockbroker, as an ex-stockbroker, obviously, I note with interest the trends in markets. and I see effectively a valuation bubble in equities, I can therefore anticipate that that will unwind, and that will unwind into mining companies. Now, I'm not in the business of investing or recommending investment, but as an observer, I've seen this time and time again over the last, 55 years, where I've been in the, in broking, investment management, and all the rest of it. And I also see the relationship between bond yields and equities. Now, this may surprise many of your listeners who occasionally read financial papers, who will probably expect interest rates to fall. They won't fall. They're not going to fall. They're going to continue to rise, which I can explain in a moment if you wish. Now, under those circumstances, when you see bond yields rise, then it's going to undermine the value of equities. Why? Because equities take their valuation basically from the yields on bonds. Now, so far, there's been actually a stretched disparity between the relationship such that equities are wildly overvalued on that relationship. So if we get a further rise in interest rates and therefore bond yields, then that's going to be catastrophic for equity markets. So what does an investment manager do? Well, he'll do what he's always done in the past. He'll try and rotate his portfolio, or the money he runs for poor suckers who have poured into his expertise. He will get out of, rapidly becoming unfashionable sectors and get into the sectors which are becoming fashionable. And of course, when you see the price of gold, silver, and commodities rising, and again, I can go into that for as to why in a moment if you wish. When you start seeing those rising, then quite simply, you go out and you try and invest in mines. But hold on, we've got a problem. Mining is unfashionable. It's a dirty business. It's not ESG compliant. Furthermore, because mines have underperformed the rest of the equity market very substantially for a very long period of time, there's very little expertise in evaluating whether a mine is a good investment or not. So what you're going to see is an awful lot of money coming for a sector where there's not an awful lot of analytical expertise. And that is going to determine what is bought. And it'll be the big stocks first. And then the brokers will start investing in analytical expertise in greater depth. And then you will find that you get the mythical 10 baggers, 20 baggers, whatever, which long-term gold bugs, salivate over. So that's, that is ahead of us. And I don't say this as someone who recommending investments at all. I just say this as an observer, drawing on my experience of how these things play out.
Something that I want to shift to, Charlie Munger, who is a well-known investing giant, he gave a speech in 1995 about the psychology of human misjudgment. And he explains that behavior economics can be applied to business and investing. I'm curious to ask you, what are some mental models that you have learned over the years that you have applied to make smarter investment decisions, or even if it's not investing, life decisions in your life?
Learn to read a balance sheet. That, I think, is probably the most important thing. It's not difficult to do, but it's well worth taking the time and effort to do it. And then when you analyze something, you've got to also take into account whether the balance sheet is true. And there's an awful lot of skullduggery goes on in terms of valuations and so on. I mean, particularly if you look at banking balance sheets, as the Fed openly encourages. It has encouraged banks to, that has now officially stopped, to value their bond holdings at redemption value. They had this plan in the wake of the regional bank failures earlier last year. That is something you've got to look out for, and particularly if you're analyzing foreign investments, because they all work on different standards. So I think that's the first thing. And secondly, you need to develop a judgment on not only the product itself, let's say, I mean, we had a classic in this country for years and years and years and years. Cadbury Schweppes produced a tonic. It was, the gin and tonic was always a gin with a Schweppes tonic. And then another company came along called Fever Tree, and they listed on the London Stock Exchange. And the shares have done incredibly well because what they did was they came up with more attractive products in an established market and basically drove sales in the established market down by being more successful. So you need to be able to make judgments about the products itself and whether that's likely to catch on. And then, of course, there's the management. Management has to be entrepreneurial, and it also has to be it's got to have a real understanding that the customer is king. And that's something which I'm afraid is sadly lacking nowadays. I mean, with regulation, it's the regulator is king, not the customer, for so many businesses. And we had a comedy show in this country where one of the comedians, a guy called David Williams, it basically, the scene would be in an airport, and he would be behind the desk, if you like, with a computer, and customer asks a question. You go, the computers say no, and that basically is the way many businesses are run. The computer says no, so you, customer, can piss off. That is the sort of arrogance which so many companies have now. And when you come across that, then that's a bad investment. And also, it's someone on a personal level you shouldn't be dealing with.
What are some investing rules that you stand by?
If you have identified something and you really believe that is the right thing to buy, then the answer basically is you go for it as much as you can. This idea of having a diversified portfolio where you don't put more than 5% in any one investment, at that stage you chuck that out. Now, you don't obviously put everything into one stock, but if you're really going to make money, then you need to back your judgment, and you do not back your judgment by having a widely diversified portfolio. All you're doing then is you're buying a market average, which any idiot can do.
I'm curious to ask, what have been the most influential books that have had such an impact on your life?
It was a good question. I mean, I was sort of latterly became an Austrian economist, if you like. And so I think basically the writings of Ludwig von Mises, and I would recommend anyone to go onto them. Now, I would say the one thing about the Austrian School of Economics, their grasp, I'm talking about the modern school, as it were, their grasp of credit, I think, is somewhat lacking. You will find a lot of Austrian economists follow the Rothbardian line that credit is bad. It's, and the idea that banks can expand their balance sheets, so that the ratio of assets to equity, just becomes sort of 10, 15 times, whatever. That is bad. But the problem is trying to find an alternative. The world actually works on credit, and I think this is something that a lot of the Austrians don't really understand. But other than that, other books. Well, sort of, I read history when I can be bothered. But I think generally, what I tend not to do is to read too much as a means of trying to gain, if you like, information, trying to gain an understanding and so on. I will certainly read a certain amount, but I don't want to get overly influenced by other people's thinking, if you like. So I disregard a lot of philosophy because it's not really relevant to what I'm doing. I think it's important, certainly from my perspective, if I'm going to impart anything to other people in terms of knowledge, that I think things through, rather than I just repeat what other writers have already said. I mean, I may, I can pick up on various points and all the rest of it that they make, and I don't dismiss writers entirely. I am reasonably widely read, but the idea that I use references, if you like, as the basis for my research, that's not right. And I think there's a great flaw in this idea that a bit of research is only credible if it's got all the sort of references. You get a book and you see that the pages and pages of references, or you get an article, pages and pages of bloody references. It's immaterial. I think it just shows that the writer is not necessarily thinking. If he has to rely on other references, not thinking it through. And so often these references are wrong, just plain wrong. I mean, a lot of economics, I mean, if you look at the whole of the Keynesian paradigm, about which virtually every Western economist bases their theories, their economic theories upon, so much of that is basically completely wrong. Yet anyone, let's say a PhD working for the Fed, producing a paper, will do reference after reference after reference to give the paper, it gives the paper respectability, if you like, and it shows up the writer as someone who really knows his subject, but actually it's ignorance leading into greater ignorance. And I think that's something that people should actually watch out for. And I tried very, very hard not to fall into that trap.
Wouldn't you also say that's like following the herd mentality? Like if you're hearing a lot of information rather than thinking for yourself, you're just taking what's out there and copying it?
Yeah, absolutely. I mean, that's, I don't think that provides any added value, if you like, at all. What can provide added value is passing on hard information. Yes. And I do that on my Substack channel, because I have a Substack channel, Macleod Finance Substack. And, the way I see that is it's a service to people trying to understand what is happening in the relationship between money and credit, as I've just described the difference, what's happening to factors which determine that relationship. And that's partly an understanding of genuine economic theory rather than jumped up government economic theory, which is essentially the Keynesian approach. And it's also an unbiased view of what is going on in the wider world, particularly the geopolitical situation. I mean, we in the West, I mean, if we just go on our mainstream media, we think we're top dogs in the world, have been, always will be, and all the rest of it. And we seem to be completely unaware that the majority of the world's population is actually forming and is well advanced in these plans, forming, if you like, a rival nexus in partnership between Russia, China, Iran, now Saudi Arabia, India. A lot of these people are still sitting on the fence a bit, but you can see which way they're going. And, we can collapse our economies, and we are doing everything to collapse our economies because we are following completely misleading economic theory. Macroeconomic theory is completely misleading. We're following that while the rest of the world is basically industrializing and industrializing quite rapidly. And that's going to lead to enormous demand for commodities. So commodity prices, and here again, I'm not recommending investment, but I'm just trying to sort of relay facts. You can see that there will be massive demand for certain commodities. The commodities used to improve communications throughout Asia, between Asia and Africa in particular, and also into Latin America. All those commodities, you're going to see increasing demand and long-term demand for them, you look at the supplies, and most large mine supplies have been identified. There doesn't seem to be really anything new coming on stream. On top of that, you can see the declining value in Western credit, led by the dollar, if you like. So both from the dollar going down and the long-term demand for commodities, you can see that priced in dollars, commodities are going to appear to rise quite strongly. That is the future we have. And, you know, all I would say is that we are destroying ourselves with, you know, I mean, just out of ignorance, complete ignorance, political ignorance, if you like, political ignorance about what the economic consequences are of policies. We're destroying ourselves, but thank goodness there is another part of the world which is going to take up the running and ensure that civilization continues. I mean, the way we're going, you know, we have basically got to destroy our entire democratic system because of where it has led us. And that will happen because we will have credit collapsing in value, and nobody will be able to rescue us from that collapse unless the politicians really understand what is necessary. And central to that is sound money, which is gold. And guess who's all got the gold? Well, China, Russia. I reckon that Russia, I mean, I've got friends who have sort of quasi-intelligent sources, and I'm led to believe that the Russians actually have something like 12,000 tons of gold. That's more than the US claims to have. The US, which seems to have difficulty delivering gold to those who own it, like Germany. The Americans who allegedly, every time they arrange a coup d'etat, such as in Libya, or indeed in the Ukraine back in 2014, first thing that happens is the Apache helicopters come in and, you know, people dressed in black run in, grab the gold, and then fly off with it. I mean, you know, this is documented. Whether it's documented accurately or not, I can't really comment. But you can see that the rest of the world actually does understand the importance of gold, whereas we've dismissed it. We've dismissed it at our peril. We had in Britain, we had back in the year 2000, 2001, 2002, we sold off most of our gold because we had a prime minister who got Keynesian religion. He got Keynesian religion. He was I'm talking about Gordon Brown. He was a school teacher. That's all he was before he went into politics. And he was taught his economics by a guy called Ed Balls, who eventually became his chancellor. But Ed Balls basically was a Keynesian economist, you know, with all the qualifications, I don't know, Oxford, Harvard, and all the rest of it, who was a leading journalist for the Financial Times, a heavily Keynesian newspaper, a newspaper which would only employ Keynesians. So you can see that the mistakes that have been made, those errors are still with us. And, you know, I mean, in the past, you know, whenever I've sort of tried to address this in the UK, I get completely rebuffed. It's a subject which nobody wants to talk about, but we don't have. I mean, we've got 300 tons here. Canada's got nothing, incidentally. So, you know, how on earth, as a government, you know, you got yourselves into that position. I say this because you're interviewing me from Quebec. It just, you know, it's just unbelievable. It is crazy. We have led ourselves into a position from which there is absolutely no escape. We do not have the mentality to escape from our own predicament. And this is why I strongly advise anyone, and this is not investment advice, I advise anyone who understands that they are entirely exposed to credit, that they should take a little bit of insurance and get some real money. Telling people to have cash, i.e. real money, is not investment advice.
Yeah, I think having real sound money is very important in today's times. What is your biggest fear, for your children? You're in your 70s. You must have some fears for your children and your grandchildren.
I think it's a very good question. It's not just children and grandchildren. It's also those in your community, because we all live somewhere. We live in a community. And my fears are that nobody is really prepared for this. Our children, they're not prepared for it. I mean, the problem I think that anyone who has this understanding has is that they talk to their friends and families about it and they think, you're off your rocker, because they can't envisage the situation where the value of credit basically goes down the swanning. Just read a bit of history. Read about what happened in Germany. They went through two currency collapses, 1923 following the First World War, and also 1945 to 7 following the Second World War, when the mark became completely valueless and they had to redo it completely. First time round, it was the effect of this was actually very, very marked, because it just basically impoverished not only the poor, even more so, but also the professional classes. They were impoverished. The speculators did well out of it. Foreign students were able to buy streets of houses out of their allowance from mummy and daddy in America, coming over from America, because dollars were convertible into gold at $20.67 to the ounce. So it was a hard currency, and you want hard currencies. We have no hard currencies in the world today, none whatsoever. There is no currency which acts, if you like, as a gold substitute. None at all. But you can bet your bottom dollar that as soon as the dollar starts collapsing, you will find that the Asians will start putting their currencies onto gold standards. Whether it turns out to be credible or not, we will only see in in due course. But it's easy enough for them to do. China has accumulated an awful lot of gold, and don't just look at what People's Bank has got. They have been accumulating gold since 1983 at least. Not only that, but delivered into public hands from the Shanghai Gold Exchange since 2008 is around about 25,000 tons. So, you look at China, I reckon the Chinese government in various accounts, if you like People's Liberation Army and also the Communist Youth Wing and so on. I mean, these various accounts, I think they've got their gold sort of hidden in these accounts. I reckon they've got over 30,000 tons there, and it could be as much as 40. So, but if you look at the above ground gold stocks, which are estimated to be around about 200,000 tons, China has probably got something like, between the government and its people, probably got somewhere between 60 and 70,000 tons of that. That's like 30%, 30 to 35% of the world's known above ground stocks. What have we got? Well, we've been just flogging our gold to them. I mean, how stupid can we get? Well, the answer is that we're ignorant. And this is an ignorance that, if you don't educate yourself about the difference between money and credit, then you will go down with it.
Going off of those words, I am more than half of your age, and I'm constantly learning and seeking information. But where would you recommend, millennials like myself go to better educate themselves on the economy so they could better understand how to preserve their wealth?
Well, I've got a biased answer to that. You might say it's biased, but the answer is subscribe to my Substack, and you will get articles covering economics, precious metals, and also geopolitics. And I have many happy travelers on that Substack channel, and there's a very active community, discussing points that I raised and all the rest of it. So I would recommend that. Also, I mean, there are other providers of information in the same sort of genre, but I would say that, perhaps one thing that you ought to do is to read some of Ludwig von Mises's works. Try and understand where he is coming from, if you like, and understand what he was saying. It's still actually very, very relevant to the situation today. I mean, this was a man who learned his economics before the First World War. After the First World War, he was sort of an advisor to the Austrian government in trying to sort out the collapse of the Austrian shilling, or crown. I think it was the crown in those days, sorry. And so he saw at first hand the whole experience of the collapse of credit. That has really driven, his subsequent analysis. But because that sort of basic, if you like, almost old-fashioned form of economic analysis, uncorrupted by government influence, if you like, because it became so unfashionable, he never got the professorships which someone of his standing should have got. But nonetheless, he didn't compromise at all. So in terms of understanding pure economics, I would strongly recommend that anyone make an effort to read his stuff. And there is the Ludwig von Mises site, and you can get all his writings absolutely free of charge. So it's worth going on, downloading a few of his books and reading them. I mean, I would strongly recommend that. Hayek as well. Hayek was another very, very influential Austrian economist who was sort of a contemporary, if you like, but just slightly younger than von Mises. But he came over to London and taught at the London School of Economics for a little while. He said of Keynes, and this is actually recorded online somewhere if you want to seek it out, that Keynes wasn't an economist at all. He's absolutely right. Hayek was a real economist. He really was. What it boils down to is free markets. Free markets work. Governments have no basis for judging how to run an economy. And as they have increasingly involved themselves with trying to run their respective economies, they have corrupted them to the point where nothing really works effectively anymore. The only businesses which really work are ones which are sort of newly invented and governments haven't yet managed to regulate, if you like. I made the comment earlier about computers say no. I mean, virtually every business is like that now. It's all regulated, which corrupts. It means that you and I as consumers are denied the choice, if you like, of the genuine choice of buying products and services. We are told by the government, or rather the manufacturers are told what they can offer us. It's not down to the relationship between a manufacturer or a service provider and you and me anymore. Caveat emptor is banned. It's we live in a nonsensical world, and it is going to come very, very unstuck. And this will be evident really in the collapse of the value of credit.
One of my questions that I ask all of my guests is, what is your definition of greatness?
Of greatness? Well, I think you have to consider it in the context of what somebody is skilled in. I mean, you can be a great athlete. You can be a great politician, a statesman. You can be a great economist. To some extent, an outsider's judgment as to greatness is probably influenced by media rather than the actual truth. You can have, I mean, someone on a local, someone around you can be really, truly great at what they're doing. I mean, whether it's, genuine care for others, in a church or something like that. An unsung hero, if you like, can be really great. So I think this is, the decision as to who is great and who isn't is really a very subjective thing. But it's something I would encourage anybody to look at from a purely objective point of view as much as possible. Someone who really does things for not just for his or her gain, if you like, but actually does it for the community as a whole, then I think that gives some measure of greatness to an individual.
I think that's a beautiful definition. So I'm definitely aligned with that. And Alasdair, before we sign off today, who is someone that you know personally that you would love to see on this show?
Oh my goodness. Who would I love to see on your show? I don't know. I mean, I think James Turk, who was my colleague at GoldMoney. He's someone who I don't know whether you've had him on the show. Who else? Who else? If you're looking purely at an investment, I would say that one of the people who I've met in the last 10, 15 years, who I would regard as a really skilled investor in precious metals, in mining, is Rick Rule. I don't know whether you've had him on. And who else? I mean, I know the moment we sign off, I'll suddenly think about half a dozen other names, but there's a couple to be going on with anyway.
Yeah, Rick Rule is definitely a great in this space. I've had him on 3 times and just every time so generous with his wisdom. Before we officially sign off now, are there any other words of wisdom that you want to leave?
Well, yeah, there's one thing which I think is actually crucial to understand, and that is when you get collapsing credit, interest rates rise, they do not fall. And I think I would leave everybody to just cogitate on that. I mean, the difference is that an economist would expect, when an economy goes into recession, that interest rates should fall. And the way to manage the recession is to lower interest rates. But a banker sees increased risk. So what does he do? He sees the necessity to raise interest rates to compensate for that risk. So I leave you with that thought in this current economic environment.
Well, I want to take the last little bit of time here to really thank you for your wisdom. Thank you for your time. It's been a pleasure speaking with you today.
Very much my pleasure, Ben. Thank you for having me on.